The opinions expressed are those of the host. The material is for informational purposes only. It does not constitute investment advice, and it is not intended as an endorsement for any specific investment. Visit crestmontpw.com for more details.
Welcome to the Ascent. This is Sam McGee, CEO and owner of Crestmont Private Wealth. At the time of the recording, it is August 7th and going to be airing on this Saturday as you're listening. It's almost time to go back to school, which, is kind of weird that kids go back to school so early these days. As it is, they are going back to school, and usually this time of year, parents are getting a little bit more free time for about 5 hours and able to get caught up on things. And some of that is finance. And so I want to catch everyone up today on kind of what's happening out in the economy and what's happening also in financial markets. We talk about this a lot, that the economy and financial markets are related, but they're not the same thing. So before we get into both, what do I mean by that? What I mean by that is the economy is really a current state of how the country or countries are doing, how businesses are doing. And it's also a little bit of a in the rear view mirror of what's happening too, because a lot of times you see economic data gets revised. It gets revised upward or downward. And so it can be a bit of a lagging indicator. Now, financial markets are more of a leading indicator. So investors vote with their dollars. And as you think about financial markets, when you get a piece of new information, good or bad, it gets reflected into financial market stock prices, bond prices almost immediately. And that is our view at Crestmont Private Wealth. We do believe in efficient markets, but really we take the semi-strong hypothesis on that. And that basically means that, in layman's terms, that markets sometimes can be a little irrational. And we've already seen that this year with market volatility after the tariff announcements, a lot of news surrounding Ukraine and other pieces that came out in the media. Markets got really volatile, almost irrational. And over 4 or 5 trading days, there was a point where the S&P 500 was down over 12%. And here we are, year to date, up around 8%. So it's rebounded, and here we are. And what's really different? So we're going to dive into the state of the economy, some kind of bullet points of things that just to kind of catch you up to speed here on this Saturday morning. And I love my kids. I'm glad they're back in school, but it's a good thing. Structure is good. Okay, so first off, unemployment data. For the United States, where we are right now at this time of recording, if you take a look at the July figures, the U.S. unemployment rate is sitting at about 4.2%. And the full employment is pretty close to that, meaning that we are way off of where we were back in, say, August 2020, where the stated unemployment rate was 8.4%. Okay, so think about that. Let's go back 5 years and think about the state of the economy 5 years ago versus today and the job market. So you had a swift shutdown of many industries, non-essential industries. You had government stimulus that was propping up, really, it was the lifeblood to keep things going. And you had a sharp rise in unemployment. And ever since then, the unemployment rate has remained at a fairly low level since really 2022. Now, it did rise a little bit over 2024. It was down to 3.7% in January of 24. But still, we're still at a historically reasonably low level at 4.2%. So that check is a good place to be. Now let's talk about the U.S. Consumer Price Index, otherwise known as an indication of inflation. We've heard a lot about inflation since 2022 when it was at its high. And the high point for that price index was a 9% rate. Okay, so that was pretty rough. This was back in June 2022. And if those of you that are involved in real estate or in interest rate sensitive industries may remember, that's when the Fed started raising rates to combat inflation, and they did their job. I mean, since then, we've seen the CPI drop. It's still hovering around 6.45 on the price index year over year percentage change. And so that's not a bad thing. It's come down about 3 percentage points in terms of their year over year change. So that is a good thing. Now, where are we today? Where are we in the economy when we look at real estate? So one of the things that we take a look at and monitor as well is obviously what's happening at the Fed with the effective Fed funds rate, the overnight rate, and what happens with interest rates, maybe on the 10-year or mortgage rates, as an example. There's also something called the Case-Shiller Home Price Index. And that is essentially a national index kind of tracking the home prices that are out there. And ever since about February, we've seen that drop. Now, has it dropped sharply? No. The index back in February of 25 was 330.11, and we're looking at today's reading. Actually, most recent reading was May, and that's 326.99 Shiller Home Index. Now, why is that? The reason for that is because interest rates have remained elevated, which typically, if you have higher interest rates, you're going to have softening demand for homes because of affordability. And you take a look at the low inventory that the country has had on homes over the course of the last, say, 4 or 5 years, historically low inventory. Prices have remained elevated while rates have been up. So what do you think is going to happen if you have high prices, you have high borrowing costs, you have low inventory, and suddenly you get more inventory? Well, prices are going to drop. You're going to have sellers that are willing to go ahead and make concessions and lower price, and even a lot of sellers just pulling out of the market, deciding, you know what, I'm not going to try to sell right now, not going to get my price, so I'm going to go ahead and delist. So we're seeing some of that, and I think that when we consider the historical rates of mortgages being around about where they are, in the upper 6s to 7s, they're not terrible rates. It's just you can get a little greedy when you have that 2.5 or 3% rate or 3.5% rate that you locked in at during 2020 or 21, and suddenly the borrowing costs are 2.5 times of that. It's a tough move to make. The real estate industry is a more balanced marketplace now. Buyers and sellers have more negotiation. It has become a little bit more of a buyer's market, but that's really in perspective to the ultra hot seller's market that occurred over the course of post-COVID. Overall, earnings from companies have been pretty strong so far this year, meaning that the U.S. economy continues to be pretty resilient. We have fairly low unemployment. Inflation is coming down. Borrowing costs are staying about the same. And so there's not some massive fissure that we're seeing right now. Now, what could happen? Now, keep in mind, past performance is not indicative of future results. What we're seeing right now is that the Fed is expected to cut rates later this year. And that's really in response to a bit of a softening in the job market recently, as well as the implied cost that we're starting to see in tariffs going into the inflation rate. So the current inflation rate, and I'm talking about U.S. inflation rate, 2.67%. So pretty low, but it had an uptick. What I talked about earlier was the change year over year. So right now we're looking at an uptick, and that came from April at 2.31. Now we're at 2.67. So we see that uptick. Do we think that the Fed is going to cut rates later this year? I think it remains to be seen, because if inflation starts coming back up, it's going to be a really tough thing to cut rates. You can't cut rates to battle inflation. The way you battle inflation is raising rates. But keep in mind, if you raise rates, that can also hurt the economy. So think about it like a seesaw. The Fed has two competing things that they're dealing with. On one side of the seesaw, you have inflation. On the other part of the seesaw, you have the economy. They're constantly trying to balance between the two. That is why they adjust rates. So it's going to be an interesting one. Definitely. Something's going to give, and I think what we will see later this year is probably, in our opinion, a pause on rates being dropped. That's what we think. But the market is implying something a little bit different. They are implying a rate cut or two. We'll see what happens. We could be wrong. Now, financial markets, where are we today? If we take a look at year to date, we take a look at the relative value in markets starting the year as to where we are now. Markets have been pretty resilient, volatile, but resilient. And I'll give you a couple pieces of statistics. So as of recording today, when we take a look at where we are year to date, taking a look at one tracked ETF against the S&P 500, the price change, which does not include the total return, which includes the dividends, is sitting at about 7.57%. And if you take a look at the snapshot of growth versus value, so the different styles of companies that are out there, ones that may pay dividends and be more mature would be value, and those that are more growth oriented. And I'm actually referring to the Russell 1000 value total return and the Russell 1000 growth total return. If you take a look at year to date where those two are, the growth total return on the Russell 1000 is sitting at 10.64% positive, where the value is sitting at 6.21% positive, both year to date, and that's through August 7th. So it's really been a pretty good year. You take a look at where the economy is, you take a look at some of the resilience that we've seen from a lot of the headline risk, a lot of the geopolitical risk that has occurred with Iran, with Ukraine, Russia. It's actually been a pretty solid year. I thought this would be a nice little update for those of you that are getting caught up on life after vacation and just trying to understand where we stand today, because news moves very fast and maybe you're not completely caught up. Hopefully this has given you a little bit of insight into how the Fed works, as well as where markets are, where the economy is today. And, we don't have tomorrow's newspapers. And that's exactly why at Crestmont Private Wealth, we take the approach of broad diversification. Every client has a very unique, customized financial plan. And so if this has struck a chord with you and you would like to have a review, we are here at 604 South Main Street in Boerne, Texas, as well as One River Way in Houston, Texas. And we do work with clients really all over the United States. So reach out to us at info@crestmontpw.com. You can also see this podcast, other content on our website, crestmontpw.com, and get in touch. We'd love to hear from you. Have a great weekend, and God bless.